they were a year ago. And we even think housing is probably at or near the bottom if you look at rental prices, supply and demand, household formation. So I'm hoping we have a growing economy and jobs.
You speak to a lot of CEOs. Are you seeing a lot of backlog in terms of plans to do deals, IPO? What does your pipeline at JP Morgan look like?
I would say there's a lot of chatter out there. Companies have a lot of money and a lot of wherewithal. And, like everybody else, they always worry. But if you ask them, they're worried about the world, they ask them about themselves, they think they're doing okay. So I think companies are doing okay and want to expand and grow.
And, of course, even with the better data, the bank stocks have been under tremendous pressure. Your company losing some $40 billion in market value in the last year. Investors want to know what's going to turn this around. Let me turn to Europe, because it seems like that's the pressure on valuations. Merkel and Sarkozy meeting today. If you were in that room, what would be your recommendation to fix the euro debt crisis and get this volatility out of the equity and currency markets?
So remember, banks have a lot of issues that they're sitting on them right now, including Europe, which may be the largest of them. Europe is kind of the thing. First of all, we would like to see Europe solve its problems. I think the European Union and the euro itself is a great accomplishment of mankind. And it is one of those examples where everyone's right. Any country that says we want to see all countries be financially responsible, I think they're accurate. To do that, it means that they have more common social policy about retirement, work hours, competitiveness, etc. I think it's fair for the ECB to say that this is not our issue, it's a government issue, but how they run fiscal policy. I think it's fair for the governments to say the ECB needs to help provide liquidity, particularly for Spanish and Italian sovereign debt. So they have a lot of issues to work out. They need to be done almost together and soon, because I think the longer you wait, the higher the risk is that something goes wrong that you can't control.
So what's your view on what the ECB has done so far in terms of its lending facility?
I think this last thing they did, I think about 3 or 4 weeks ago, where they expanded the amount of collateral can be used, and they said if you have the collateral, you can borrow for 3 years, pretty much at very low rates. I think it was a huge. It removed a lot of issues about liquidity and funding of the banks. So I think that issue was almost taken off the table by that one move. The banks there still have to raise capital. They've been asked by the regulators to raise capital, and to do that, they may have to sell certain assets and do other things. But one of the big issues was removed.
What is JP Morgan's exposure to these troubled nations like Spain, Italy, Portugal?
So we make that disclosure. Those countries is about $15 billion net, meaning net of collateral, all those various things. Most of the collateral is cash. And, we stress it, and we think if there's a terrible disaster, a terrible outcome, we can lose $5 billion. But remember, JP Morgan makes this decision to keep their exposure, not because we're taking a bet, not because we're betting, but we've been doing business in Spain and Italy for 100 years. We want to be there in 100 years. Most of what we do there it was related to client-type business. So we're trying to manage the exposure. Hopefully the worst won't happen. If it does happen, I'm not going to feel terrible. I'll feel terrible for them. We'll still try to be doing business in those countries.
Is there an unknowable component, though, to this? I mean, can any management be sure that the hedges put in place, the hedges relied on by their counterparties, are going to be effective if, in fact, we were to see a sovereign restructuring?
So I think the unknown part is what happens in the political situation there, not what happens with the hedges. A lot of the collateral is cash. That's obviously fine, not held in the country. A lot of the collateral we do hold is not cash, is not Italian or Spanish sovereign debt. And a lot of the so-called other hedges are with counterparties outside of those countries. And we look at those one by one. So we know the exposure of every single counterparty. Yeah, something go wrong, but not terribly wrong.
Let's get your take on the stress tests. JP Morgan has submitted its plan to the Federal Reserve. We'll get those results in March. How does JP Morgan come out on this?
Well, first of all, I think there's a very good thing with the stress test. Okay? I don't agree with all of it, but I agree with stress tests. You should be able to look at a JP Morgan and say, can you handle massive stress? Now, the stress here, folks, is 13% unemployment, home prices down 20%, equity markets down 50%, a catastrophe in the markets, and a catastrophe in Europe. And yes, we can handle all that and be we think well above the 5% Tier 1 capital required. I'm hoping what it shows is that the American banks, and maybe an exception or two, are extremely well capitalized, can handle extreme stress, and maybe one day we'll just take this issue off the table. I also believe, by the way, they can prove the point I've been trying to make publicly. At one point, we get too much capital, because we're going to be asked to hold a lot more capital than this number. I just personally think that's too much. Maybe this helps prove that.
Well, your bank, under the SIFI rules, has an additional buffer, 2.5%.
Another 2.5%.
Yeah, so, I mean, how much capital should a bank be holding?
Well, I think enough to handle extreme stress.
Yeah.
Or more, but we have the more. I mean, after all the stress tests, we're still going to have, they're asking for 5%. We'll probably be 7 or 8% or something like that.
All right, so you...
After extreme stress. It's almost 10%, where it was almost 10% at the end of last quarter.
So you come out of the Fed, let's say hypothetical, all is fine, you've got plenty of capital. Do you raise your dividend?
Well, first of all, it's a board-level decision. When we raised it last week, put it back to $1, we told the world that we would expect when we start that, to have regular, not huge type of increases, but as a normal course. That's a very small capital decision relative to other capital decisions. So last year we also bought back $8 billion worth of stock. And so, we think that we might do something like that this year. At least the last disclosure we made is that we hope to do that or more in 2012.
What's more?
But for us, it's also very important. Is that what price? We're not the kind of people who buy stock back at any price. We prefer to spend that money when the stock is cheap, but it may not be so cheap by the time we have the opportunity to do that.
What's more important, though, buybacks or dividend payback? I mean, people are looking at your stock. They've lost money in 2011. How are you going to get capital back to shareholders?
Yeah, so honestly, believe it or not, I don't worry about either of those two statements you made about losing money in a year. We build a company for the long run. We want to serve clients, more companies, more branches, better systems, better products, better services. We've 3 quarters year-to-date record earnings with all the bad stuff in the environment. We're just going to keep on building the company. The stock will eventually take care of itself. So also, I think returning cash to shows, we've got to do it in the show's best interest. So buying back stock, to me, only makes sense when you think you're buying it below intrinsic value. If you're buying it above intrinsic value, you're helping the exiting shareholders, not the remaining shareholders.
Is it below intrinsic value right now?
I believe it is, yeah.
I want to get into regulation in a moment, but let me get your take on what JP Morgan looks like once all of this noise, or whatever you want to call it, this new regulation period passes. Are there areas of the business that you'd like to be in that you're not? Areas of the business that you could see, divesting? What does the firm look like in 3 years?
I don't see anything divesting. We're changing a lot, but we're going to spend a lot of time this next year just navigating through a massive amount of rules, regulations, Basel III, LCR, FCB, FSA. I think it's going to change products and pricing, but the fundamental job of a bank on the corporate side, providing loans, credit, equity, debt, balance sheet management, is going to be the same, or advice is the same. And to a consumer, providing checking accounts, investment accounts, mortgage, et cetera, will be the same. So I think when you look at it from the consumer standpoint, these are necessary and indispensable. And I do think we're going to be able to provide them at a fair price to consumers and still earn a fair profit.
You have not cut costs to the extent of your competitors, some of your competitors. In fact, you've expanded on the traditional banking side. Even though capital markets has been pressured, is 2012 going to be a year of cost cuts?
No. I think first of all, it's not fair to say we haven't cut costs. We're always doing both. So if you actually look at the overhead of the company, like tech and ops, HR, finance, systems, and things like that, as a percent of revenues is down 9% the last 5 years. On the other hand, we've been investing that money in new systems, new branches, new bankers, new marketing, new products. You've got to do both. A company survives by doing both, not just by doing one.
Are you expecting...
So we're very cost conscious.
Are you expecting the pressure on capital markets to continue in 2012? Investors are nervous, so we know that.
I think investors may be surprised. That my experience has been that when investors are the most nervous, 6 months later, they can open up wide. So, and by what we see, if you're a corporation, you can easily raise money. We're still doing $10 billion in mortgages a month. I still think mortgage underwriting is a little tight, but we're still doing $10 billion a month. We're still doing a lot of credit cards, small business loans as of the end of September up 70% year to year. Middle market loans as of the end of September up 18% year over year. So we've seen real underlying growth in some of those numbers. Some are market share gains, but I think some of our competitors are seeing some similar numbers.
The last time we spoke at this conference 1 year ago, I asked you about SunTrust. Do you see any holes in the business that you would like to expand on, perhaps in that area of the country, the Southeast? Would regulators even allow you to get bigger in the U.S.?
I don't know if they would. I think it would be a political issue. I think if there's something that made a lot of sense, I'd go to the board and we'd have a conversation about whether it's worth taking the political risk. But I think we might. But at the end of the day, what we've really focused on is just organic growth. So we've opened in the last 5 years something like 800 branches. We've added hundreds of salespeople in those branches. We've opened something like 20 branches overseas to serve multinational clients. We've added hundreds of private bankers, and we've been building out our prime broker platform. We've been expanding the commodities business. So we're just expanding organically. So the plan is just grow organically. Bankers, branches, systems, products, services.
But What about expanding in terms of taking advantage of some of the trouble in Europe? We've seen some divestitures. We know that there are a ton of loans there. Are you a buyer of some of those loans? Would you buy businesses that are divested from some of these European banks?
Yeah, first of all, we really want Europe to recover. We're not trying to be a beneficiary of the suffering that they're going through here. Having said that, there are certain assets, divisions, some we've actually bought, some we made bids on and didn't get, and some we're still looking at. There'll be some of that. We've seen less of that than you expect. We do see European banks backing out of some revolvers and trade finance, but it's not this mountain of stuff coming out of them.
You know, when we were promoting this interview, I was tweeting about it. A lot of people wanted me to ask you about MF Global. Okay, what went on at MF Global and why JP Morgan should be getting paid back before some of the customers that saw their segregated funds stolen.
I don't know what you're talking about JP Morgan being paid back. JP Morgan did business with them or owed a lot of money by them. And I'm hoping all those segregated funds are still found. I still think there's a good chance. But JP Morgan is just another creditor. And so, that situation will have to sort itself out. I think they're referring to one overdraft that was prepaid a couple of days before the bankruptcy. That was an overdraft. It was prepaid in the ordinary course of business.
Let me ask you about the Volcker Rule and some of these other regulations. You've got new regulations and derivatives that could very well change the economics of a business that JP Morgan is a leader in. The Volcker Rule with proprietary trading, that's supposed to be implemented in July. Do you think it happens in July? And what are you going to do to change the business, given some of these businesses that you're number one in may very well see much a different economic story?
So I don't know about July. I think it needs to be done right, not quickly, but hopefully it can be done right in July. First of all, people should remember the United States has the deepest, widest, and most transparent capital markets in the world. And if you want to execute a securities transaction, whether it's an equity, debt, derivatives, it's got the lowest bid-ask spread in the world. And you can go on your BlackBerry and actually get real transparency in those spreads. They've been coming down for years. The value of that is to the investor. Okay, that's a huge value, no different than what Walmart does by giving their client a lower price, or what Costco does, or another company. So let's just not destroy that. We have no problem with no proprietary trading. We just want to make sure that market making, that you can buy and sell securities to make markets active for your customers, which keeps that bid-ask spread narrow. That's a good thing. I understand the regulators don't want too much risk being taken. I agree with that too. But it should be overprescribed. I mean, some of the things I read, that if you want to be a trader, you're going to have a lawyer and a psychiatrist sitting next to you determining what was your intent every time you did something. So we need to be able to actively make markets for our clients. And all securities are different. If it's very liquid, it could be different than if it's very liquid. And so it's good for clients. In fact, matter of fact, a lot of letters are going into Washington from major investors saying don't reduce the liquidity in the marketplace that are made by market makers. That's good for us. And we represent unions, pensions, widows, retirees, military. Please don't do that. So I think if it's done in the clear light of day, we should be fine.
You put together, obviously, the best in class of your industry. And it seems to some people that you may have a similar problem that Sandy Weil had when you were working with him so many years ago. And that is, you've got a great management team, but you're not going anywhere. So how are you going to incentivize your people, your top-level people, so that they don't go become CEOs somewhere else?
Yeah, so first, I'm not sure we're best in class everywhere. And